All right, everybody. So it is 7:30 where I am, 5:30 on the Pacific, and 8:30 Eastern. So we're going to go ahead and kick it off. Again, if you just joined in, this is going to be the same presentation as last week. We had some issues last week. So when we recorded, there were some things going on, and we didn't want to upload that kind of stuff. So I'm going to be teaching what I taught last week. Also, I'm not going to be having a question and answer at the end of this presentation because it's my birthday and I said I like to spend it with my family. So I still wanted to come on here. It's my time to teach. So I wanted to come and teach. So next week I will be doing a live Q&A. That's all I'm going to be doing next week is a Q&A. So save your questions for there. Or you can see on the screen here, my Instagram and Twitter is at DecadeInvestor. So you can go and send me a message tonight or any time of the week and I will get back to you. But with that being said, let's just dive into this presentation. How to handle a stock market crash. So that'll be what I'll be talking about today for about 15, 30 minutes. And then that'll be it. But let's dive into it. So the first thing to keep in mind is this. Historical performance of a stock or the fund or the stock market as a whole does not predict nor promise future performance of the stock market. So, you look back and you see, ARK returned X amount of money, percent last year, or Apple returned X amount, or whatever the case is. The historical performance of that stock, of that fund, or the stock market as a whole does not predict nor promise future performance of the stock market. So it's just something to keep in mind as we go through this presentation that, what I talked about, what happened in the past is not going to say that in the future that it will happen. However, it's good to look at the past so we can at least make some predictions of what we think will happen in the future. So by definition, what is a market crash? There's a lot of, talk you might see on social media or the news talking about a market crash. What is it? What are they talking about? So there is no set numeric value to define a crash, but it is generally accepted that a 10% or greater decline in the market over a period of a few days. So over, 2, 3 days, 4 days, a decline of 10% or greater is what determines a market crash. Now, that doesn't mean that, it has to be 10% decline in 5 days or, 8% decline in 1 day. It's just a generally accepted number. It's not like a set in stone, 10%. It's just a generally accepted number. So these kind of market crashes, they bring large, quick drops. So you see that the chart, if you look at the chart, you'll see that huge drop off like we saw in 2020 last year around this time. I'll show you later on some graphs here on this presentation. Now, keep in mind that a market crash is different than a bear market. So you might hear people talk about, bull markets and bear markets. A bull market is an upward rising market, upward trend market. A bear market is a steady decline over months and years. So a market crash is a quick, quick drop in a few days. A bear market is a steady decline over months and years. So usually, not always crashes are the beginning of a bear market. However, there are, just keep in mind there's a difference. So I'm talking about market crashes. So quick drops, quick declines, quick sell-offs in a short period of days. Just to run back some historical market crashes that have happened in the history of the stock market. If we go back to 1929, was the start of the Great Depression. In 1 day, there was a 13% decline in the market, and just in 1 day. We know the Great Depression was, very, very bad in the stock market over the long term, but in 1 day, there was a 13% decrease in, again, in 1 day. 1987, what is known as Black Monday, there was a 22.6% decline in 1 day. 22.6%, almost a fourth of the market declined in 1 day. So, massive quick crash right there. 2008 financial crisis, there was 18% lost in 1 week. So, over a 5-day span, 18% decline in the market. And then most recently that we all are fresh in our minds is 2020, last year, this time, there was 12.93% decline in 1 day. So we see these four here, massive, massive declines in the market in a short period of time, whether it be 1 day for most of these or 1 week for 2008. But see how there's a double-digit decline in a short amount of time. So when it comes to a market crash, when it comes to, a crash in the market, there are three things that we can do as investors. Number one is we can sell our shares. Number two is we can hold our shares. And number three is we can actually buy more shares. So I'll break these down in the next couple slides, but these are the three things that we can do if the market crashes. There's three actions we can take: sell, hold, or buy. The first one here is sell. So you see that decline, the dramatic decline, and you sell, you decide to sell. So this is usually out of fear. I put that in parentheses because it is usually out of fear. You sell out of fear. You see your portfolio in the red. You see your stocks in the red. So it's usually out of fear. If you sell your shares, if that is a taxable account, you will see a tax liability for selling if you sold for a gain. So you sell those shares and you're hit with taxes if you sold for a gain. Number two is the missed opportunity of the recovery. So we look back in 2020, right? The market recovered in 5 or 6 months. So if you sold, you missed out on that recovery of the market bringing back up to where it was prior to the crash, and now, at all-time highs. So if you sell, you're hit with tax if it's in a taxable account and you sell for a gain, but also you miss the opportunity of the recovery of that stock, right? Now, again, it's not always guaranteed, or every stock isn't going to recover. But if you're looking at a broad market view, right? If you're holding like an index fund or a ETF that's very broad market, you're going to miss that opportunity of the recovery. So this is something that I do not do as an investor. Whenever there is a crash, I'm investing for the long term. I'm investing into stocks, into funds that I believe that will continue to grow long term, whether they crash today or tomorrow or in 2020, right? I didn't sell. I don't sell. That is something I did not do. The second thing you can do is you can hold your shares. So number one is to sell. Number two is hold. So if you hold your shares, you won't realize any losses or gains because it all happened within your account. So you're not actually realizing those gains or losses. It's just on paper. And you also enjoy the gains if the market recovers. So let's take, for example, last year this time, you held during the market, that crash of COVID in 2020, you didn't sell, you held those shares, and now the market's back up higher than what it was prior to 2020. So you actually enjoyed those gains from the market recovery. So that's the second thing you can do. That's what I do. I hold my shares. So I don't sell, I hold. And the final thing I do is I buy more shares. I see it down the bottom. This is what I do. Buy more shares. Now, I know if you're a new investor into the market, it sounds crazy, like last year this time, right? It sounds crazy that, everything's in the red and you actually want to buy more. But this is why I buy more. Because you're getting those shares of that stock or that fund or that index fund, whatever it is, you're getting those shares at a discount compared to before the dip. So we go back to last year, 2020, right? Let's say a stock's trading at $100 and it falls to $60. And we know that it probably fell, just for example, it probably fell because of coronavirus. Let's just say for this example, it fell because of coronavirus. So it's valued at 100 real time, but since of COVID, it fell to 60. So now you invest, $100 a month into this stock. Before, you could only buy one share. Now you can buy more than one share, almost 2 shares of this stock, because it's now valued at $60 versus 100. So, again, it might sound crazy to new investors, but if you're investing for the long term and you're buying into stocks and companies that you believe in long term, that when there is a crash, you don't sell, you don't do number one, you do number two, and you do number three. You hold, and you actually, if you can, you're able to buy more. Because I'll show you here in the next couple slides why that's the case. So right here, this is the case. Historically speaking, why number two and number three? Why do you hold and buy more and not sell? Historically speaking, the stock market has always recovered. I say that with a grain of salt because, again, we don't know in the future if it ever, if it will, but in the past, since 1929, the Great Depression, way back there, it's always recovered. In 2008, it took 2.5 years from pre-crash numbers to return those numbers and get to all-time highs. In 2020, it took 6 months, but it did recover. It has always recovered, historically speaking. I keep saying that, and you're probably like, why is, Colin saying, historically speaking, so much? Because, again, I don't want to promise anything because nothing's promised in the market. But looking back, it has always recovered. So that's why I hold and I buy more, because those shares, those stocks are on they're on sale for their price. So I buy more. So when they return back to where they were, if they do, then I'm getting, bigger gains because I bought more at that lower price. So just keep in mind, we can't predict the future, but it's a good track record that's went through all those things: 1929, 1987, 2000, 2008, 2020, and the stock market has still recovered. All those times it has recovered and, back at all-time highs. So there's these two graphs I want to show you here. The first one here is the S&P 500, the top one here. I don't know if you can see my mouse, but if you go way to the left, that small little dip. So there's 1991, just to the left, there's a small little dip. That's 1987. So that small little dip, you can see it's recovered since then. We go to 2000, 2001. It was up high. It crashed, but it got back. And it's hard to see because we're zoomed out so far, but it actually did reach all-time highs right before 2008 in the crash right there. And then, we got back in a couple of years. I got on the last slide, 2.5 years. We recovered, and now we got to 2020, and that crash was super, super small. But we recovered already at all-time highs. This screenshot was from last week, but just goes to show you that, S&P 500, 505 technically, but 500 largest companies in the United States, how they've endured these crashes: 1987, 2000, 2008, and 2020. It has always recovered. The second graph down here is the Dow Jones, just another index we can look at. 1987, right here, small little dip, we recovered. 2000, not much of a crash compared to the S&P 500, but there was one and it recovered. 2008, there was a little bit of a bigger one and it recovered. And then 2020, it recovered. So these graphs are really telling, in my eyes, that the market, if you zoom out, that's why I always tell people to zoom out. So it's hard to zoom out when you're in it. Last year, 2020, March, April, May, it was hard to zoom out and see that, what we see now. Always hindsight's always 2020, but we need to zoom out. We need to zoom out during these crashes because basically what I tell people is this: if you're investing in an S&P 500 ETF or index fund or total stock market index fund or ETF, and if that goes to zero, then we have other things that we need to worry about than what our investments are, right? So basically, when you're putting your money into these broad market index funds and ETFs, even during dips and crashes, what you're essentially doing is you're betting, and I hate to use the word betting, but it's the best word I can think of, betting on America to get out of the rut we are in. So, 2008, for example, you bought in at this time, right in that crash. You're essentially betting that America will get past this 2008 financial crisis, and it did, right? In 2020, you bought the dip. You bet that America is going to get out of that, financially wise speaking, stock market wise, is going to get out of that. And there's an interesting statistic that it's some of the best returns in the stock market actually come from the dips. So some of the best returns that you can get in the stock market come from buying these dips. So if you're looking to get good returns on your money, historically speaking, the best returns have come from buying the dips, because if you see the recoveries in 2008 on the S&P 500 and 2020. So just some statistics, some things to think about, how the market has endured the past financial crises, the past market crashes, how the market itself has endured and how it's recovered. Again, not always promised, but it's something that is super important to think about, just to zoom out and look at it from a bigger picture. Because for me personally, I know I can't speak for everybody, but for me personally, I'm investing my money for 10 plus, 20 plus, 30 plus years. And so, basically zoom out from a 1 year, a 3 month or a 5 month vision and zoom out to 10 years. And it makes investing a lot less, scary, because essentially you're just saying, over this 10, 20, 30 year span, I believe, America as stock market wise will continue to get better. So just some graphs to think about, some things to look at, because it's always important to see that, how has this stock, how has this index done in the past, and what can I predict for myself in the future what's going to happen. No one knows when the market's going to crash. There's speculation that could happen soon. It could happen this year. It could happen next year. No one truly knows. It's all speculation, right? So what we have to do as investors, we have to prepare ourselves for that, whether that comes, in a month, or whether that comes in a year, or whether it never happens. We have to prepare ourselves, and we can use the past performances of the market to make a best educated guess, a best educated plan and strategy for that, if it were to occur. So what do you do if there is a market crash? What are you able to do? Well, the answer is this: you can sell, right? It's your portfolio. You have the right to do whatever you want to do, right? I'm not here to tell you. No one going to tell you what you should do. You have the right to sell. But if you look in the past, like I was just explaining, if you look back at the graphs that I just showed you, successful long-term investors, right? We want to look at the best long-term investor in my eyes is Warren Buffett. He did not sell during the crashes, right? He didn't sell during the crashes. Yeah, he might have sold off certain stocks, but overall, he didn't sell. He didn't just sell everything out of fear. He bought more. He bought more. He held throughout the market, throughout the crashes. And I said this last part here. They held. These successful long-term investors, they held. And if they were able, they even bought more, right? You saw Chris on social media all last year. On my social medias at DecadeInvestor, I'm open about my stuff too. And I bought as much as I could last year, right? I bought that crash that everyone was running from out of 2020. I bought more, and I'm getting rewarded from it because I didn't run, right? I went against the grain of most people, and I actually bought more. And Chris did that, as well as many other people on social media that talk about finances. But that's I mean, at the end of the day, if there is a market crash in the future, whether it comes, sooner rather than later, that you can sell, you can hold, or you can buy more. I'm going to tell you my strategy. I'm going to hold and I'm going to buy more, right? I'm going to hold. And then when I have money, I'm going to buy more. I'm going to buy the sales of the stocks and the funds that I believe in long-term. So ultimately it's your decision, but I hope that this lesson was just a way for you to get thinking about it, right? Just because we're hearing a lot of things in the news, or on social media or something about market crashes, whatever the case may be. I hope that this lesson, gets your mind thinking about at least building a strategy for it. Maybe you want to hedge with different investments to not fall down as much, or maybe you want to just let your portfolio ride, hold and buy more, or maybe you want to sell. I'm not saying selling is the wrong thing to do. In my eyes, I don't think it's the best thing you can do. So I think there's better ways to go about it, but that's my opinion for me. But like I said, I'm not going to be taking any questions tonight because it's my birthday. I just turned 23 years old, so I'm a youngin', but it's my birthday and I would like to celebrate with my family here.